All right. Today is Sunday, July 17th, and this is a recap for the stock market activities last week and an outlook for the week to come, plus a macroeconomics discussion. But we start with this. You might be already aware that the US dollar is quote unquote strong. Meanwhile, the euro is trash. Well, what does that mean? It means a lot of American tourists are coming to Europe. Yep, if you are one of these European viewers that we have in this program, be prepared for the influx of obnoxious, rude, and loud American tourists coming to your country and splurging, which I believe it's good for your economies because they're trash right now. They're on the verge of collapsing, so the American tourists, there you go, to the rescue. And I thought to myself, maybe this is a good time to renew my passport. Maybe I'll travel somewhere, I don't know. But I'll just renew it in case. Well, little to my knowledge, it takes about 11 weeks to renew your passport in this country. Yep. I know, by the way, you gotta take an appointment before you do that, and that takes around 4 weeks. So it takes about 15 weeks to renew a passport. A piece of paper. It takes 15 weeks to do that. And I never understood that. It takes 15 weeks to renew a passport. It takes a few months to renew your driver license. It takes centuries to get a business permit, not to mention, of course, being an immigrant in this country. It takes about till you're 90 years old before you get your papers done. It's easier just to cross the borders. You get free health care, free housing, benefits, no problems. It's a lot easier than applying and following the rules. And again, it's mind-boggling to me that we can send a telescope to space, which is now over 1 million miles away from the planet. And we sent that a few months ago, and it's already over 1 million miles away from the planet. Yet somehow my passport takes 15 weeks to be renewed. And look at this. This is the picture that we got from the telescope by NASA. All of these galaxies, billions of light years away from us. And of course, this serves as an inspiration to American citizens. When we look at all of these galaxies, billions of light years away, oh, here's my passport renewal. It's about 7 billion light years away. Oh, look, here's my driver license renewal. That's about 4 billion light years away. And remember that stimmy check that you never got? Oh, that's about a gazillion light years away. Your IRS refund, that's about 5 billion light years away. And it goes on and on and on. It's amazing, isn't it? But anyhow, before we get too negative right from the get-go, let's move on to cover the macroeconomics discussion that we have for you tonight. And here it is, in focus. Deal or no deal? What are we talking about here? You like playing games? I like playing games. How about this game? You can participate. You can let me know in the comments. And of course, I was going to call it Titan or no Titan, but that sounds like the lamest game show on the planet, not to mention a little creepy. So I'm sticking to deal or no deal. Here's how you play the game. We got a slew of macroeconomics data this week. I'm going to go over each one of them, and you tell me, does this piece of data merits 100 basis points hike or more by the Federal Reserve or not? If it does, we say deal. If it doesn't, we say no deal. And by the end of the game, we will know how the Federal Reserve will act in the next meeting. And by knowing that, we know whether the stock market is going to go higher or lower. If no deal wins, meaning the Federal Reserve will stick to a maximum 75 basis points hike, which is already priced in the stock market. If deal wins, then we're going to get 100 basis points plus by the Fed, and that's not priced in, and therefore equities go down. I hope that's easy to understand. If not, that's your problem. Let's play the game. We now have expectations, after we got the 9% plus inflation data, that the Fed will unleash the biggest rate hike since 1989. Which means 100 basis points plus. But does the data merit all of that? Let's see. Data number one that we got this week is the update in the Atlanta Fed GDP tracker. For now, it appears that the GDP is moving down toward a reading of negative 2%, meaning the economy is contracting back to back. First quarter, second quarter, both negative. Now, does this piece of data on face value merits the Fed to increase interest rates by 100 basis points or more? The answer is no. On face value, you don't tighten when the economy is already getting wounded and weakening. And the reading of the GDP, at least for now, shows the economy is already slipping into a recession. I'm not talking about the moral argument or the economic argument. I'm talking about on face value. Negative GDP. Does that merit a 100 basis points hike or not? The answer is no deal. No deal. You're not going to tighten aggressively when the economy is already getting hurt. So Team No Deal gets 1. Team Deal at 0. Next, we have retail sales that we got on Friday. The headline reads, U.S. retail sales climbed in June by more than forecast in a broad advance, suggesting consumer spending is holding up despite decades-high inflation. Wait a minute here. We're not done yet. Look at this. Retail sales moving higher again, even minus gas stations. But there is a catch. The catch is, and this is from Lynn Alden, who says, a friendly reminder that due to unusually high inflation, nominal retail sales and real retail sales are telling very different pictures about the economy. Nominal sales are up, but the amount of stuff people are taking home is flat to down. What does that mean? On face value, retail sales are up because we're spending more. We're spending more in dollar amount, but that doesn't mean that we're buying more items. And this is, of course, due to inflation. Another point, what if the rich, let's say Jeff Bezos, goes into a splurging spree and he buys $3 billion worth of stuff for his new mansion or whatever? Retail sales on face value will move higher. But when you look under the hood, it happened because one man decided to spend $3 billion in a month buying stuff. Does that mean that the entirety of the economy is doing okay? Does that mean that the entirety of the economy is spending in retail? Of course not. This is how the data gets skewed, so keep that in mind. And again, it's the dollar amount that was behind the surge in retail sales, not the amount of items. And of course, gasoline stations contributed to a lot of that because you're spending more at the pump. So is this a deal or no deal? Let's cheat here, and here it is. Fed Waller, remember Waller, Governor Waller, Zombie Waller, who flips around from being a hawk to a dove depending on how the stock market trades. Well, on Friday, Waller said Friday's retail sales data to show a level of strength in consumer spending. He also added, a good report would tell me consumer demand is still strong and we can keep tightening. So what does that mean? You want to be fair? Forget about nominal and real retail spending. Let's look at the headline reading. The headline reading says, deal. It merits 100 basis points or more in rate hikes this meeting because the number is too strong. The consumer is too strong, quote unquote. So here it is on the board. Team Deal gets 1 and Team No Deal still at 1. It's a draw for now. What about this piece of data that we got on Friday? The de facto president of the United States, Senator from West Virginia, Joe Manchin, said that he would not support new climate spending or tax hikes on the wealthy. Done. He says, in his game, no deal, Mr. Biden. We're done here. No more spending because inflation is too high. Now, a lot of you libertarians, librarians, whatever you call yourself, you love this guy. Senator Manchin is saving the country. Let me tell you something. I know more about Manchin than you'll ever know. And this guy's the biggest hoe in D.C. He will literally take your phone call for the right price. And I made a video about him before. Billionaire Nelson Peltz revealed that he calls Senator Manchin every day and tells him that he's doing a good job. But of course, the money's flowing from the oligarchs left and right to fund Joe Manchin's campaigns, and his boats and yachts and Maseratis and mansions. And I'm talking about actual mansions, like big homes. But anyways, does this piece of data favors Team Deal or Team No Deal? Well, let's see. Because no more spending, the insane lunacy of spending all over the place by the BlackRock administration. Will you put a stop to that? Is that inflationary or disinflationary? Well, viewers of this channel at least know that inflation has always been a monetary phenomenon. So this doesn't really matter, but on face value, if you have the fiscal government, the fiscal spending being reduced, on face value, this is disinflationary. It means that the Fed doesn't need to tighten as much. So this piece of data does not merit the Federal Reserve to increase interest rates by more than 100 basis points in the upcoming meeting. And therefore, Team No Deal gets another score, now at 2, and Team Deal stays at 1, 2-1. Team No Deal has the lead. What about this piece of data? We got import prices. Import prices are down. Why? Because the strong dollar is canceling the increase in import prices. Is this piece of data inflationary or disinflationary? On face value, it is disinflationary, and therefore, does that merit the Fed to increase interest rates by more than 100 basis points in the upcoming meeting or not? The answer is it does not, and therefore, Team No Deal gets another score, now at 3. Meanwhile, Team Deal stays at 1. Team No Deal keeps the advantage. What about this piece of data? We got consumer sentiment on Friday from the University of Michigan, which I used to attend at some point, briefly, of course, because I'm not that smart. But according to the University of Michigan Consumer Sentiment Survey, the 5 to 10 years inflation expectations dropped down by the most since October 2020. Again, does this favor a 100 basis points plus interest rate hike, meaning a deal, or no deal, meaning we stick to 75 or maybe less? Hold that thought, because when we dig down in the Consumer Sentiment Index, it's in the trash, it's in the toilet across the board, be it consumer sentiment, consumer expectations, but current conditions improved slightly month over month. And here's perhaps a better visual for you. As you can see, the orange column is buying conditions. That improved slightly month over month, and therefore the Consumer Sentiment Index moved slightly higher. Now, what is the driver behind buying conditions improving month over month? Number one, the drop in gasoline prices. Number two, we're seeing some goods arriving, meaning if you happen to live where I live in California, you might have noticed the amount of cars, new cars all over the place. And you can spot them because they have a temporary plate. It takes about 7 billion light years to get your actual plate, but I'm noticing a lot of new cars arriving. When you talk to these people, they say, oh, I placed an order for the car few months ago, and I just got the car right now. And therefore, if you got your car, you believe that the supply chain issues are improving, and therefore buying conditions are also improving. All in all, does this piece of data merits a 100 basis points hike or not? I think the most important piece of data within this piece of data is inflation expectations in the long run, the 5 to 10 years, which went down. That gives Team No Deal another point, and they now stand at 4 to 1. Team No Deal has a significant advantage right now, meaning in the next July meeting, we're not going to get a 100 basis points plus from the Fed. This is where the game stands for now, but we have more pieces of data. What about this one? This week, we also got the Empire State Manufacturing Index, which in face value went higher, modestly, of course. So we're seeing business conditions improving slightly. You might be picky and look at prices paid and prices received, which are going down. You might say, okay, this goes for Team No Deal because prices are going down. But we're looking at the data on face value. On face value, the headline reading, an improvement month over month in the Empire State Manufacturing Index. What does that mean? It gives the Fed the cushion to go big, to go 100 basis points or even more. And therefore, I'm giving this one to Team Deal. So now we have the score stands at Team No Deal 4 versus Team Deal at 2. What does that mean? It means that the Fed will probably stick to 75 basis points hikes in the next meeting or even less. Forget about the 100 basis points plus. But remember, we have a few pieces of data from the week before and the one before that. And perhaps these two are more important than the rest. We're talking about the employment report and we're talking about the CPI and the PPI. The employment report came out hot on face value. I explained in details how employment is actually weaker when you look under the hood, but on face value, the headline reads, the economy created over 300,000 jobs. That's hot. On top of that, we got the CPI, the PPI, inflation data. On face value, that came out hot, over 9% in the CPI, over 11% in the PPI. Although you can look at the details and say, hey, the driver for the CPI was gas, and now gasoline prices are going down. You can play that game, but on face value, the employment report and the CPI, PPI inflation data, does that go under deal or no deal? I would say both of them go under deal. Why? Because you got a hot employment report, we got hot inflation data from both the CPI and PPI that merits the Fed and gives them the clear go-ahead to increase interest rates by more than 100 basis points. And therefore, the final score for now, it's a draw. Team Deal gets 4. Team No Deal gets also 4. But again, the slight advantage is for Team No Deal because of the details and because the Fed leans toward being easing than tightening. The Fed leans toward being dovish than hawkish. Specifically, looking at the equities market being down, and on top of that, the data being split down the middle. Certain data supports being more aggressive, others support being less aggressive. The Fed will always choose being less aggressive. So for now, my expectations are we head into the July meeting with a 75 basis points hike, and then in September, the Fed goes 50 or even 25 basis points. And that would be a major mistake. The fact that they're not using the economic cushion of buying ammo by increasing interest rates by 100 basis points or more in this meeting will cost them later on. In the meantime, if our expectations that the Fed will not be as hawkish as a 100 basis basis points or more in the July meeting, does that support a rebound rally, a relief rally in the equities market? The answer is yes, because the worst fears are now behind, at least for now. But here's the problem. If the stock market moves too high, too fast before the July meeting, does that go under the category of no deal or deal? The answer is it goes under the category of deal. The Fed looks at the stock market and goes, wow, stocks are up 10-15% in about a week or so before the meeting. Well, that gives us the cushion that we need to go aggressive. In other words, the market better not rally too hard, too fast before the meeting. Market bulls should be hoping for a mini rally between now and then after the meeting, after the Fed comes out and says, hey, we're doing 75 basis points, but after that, we're sticking to 50, maybe 25 in September. Boom, stocks explode higher. And if that happens, how do we play it? How do we place our bets? Do we buy Apple? Do we buy RKKKK? Do we buy fertilizer stocks? What do we do? For that, let's cover the stock market coverage, and we move on, starting by the performance of indices last week. And here we go. On Friday, the Dow Industrial Average was in the green big time by 658.09 points, or a gain of 2.15%. The Nasdaq also in the green by 201.24 points, or a gain of 1.79%. The S&P 500 in the green by 72.78 points, or a gain of 1.28%. The sector's performances on Friday all in the green. No problems here at all. Led by number 1, capturing the gold medal, financials. Number 2 for the silver, healthcare. Number 3 for the bronze, energy. Let's contrast this with the performance for the week, and here it is. Not so hot so, all in the red. We're not going to give any medals at all. The declines were led by communication services, materials, and energy. What about the advance? The decline ratios on Friday, NYSE 84% advancing versus 12% declining. The Nasdaq 68% advancing versus 27% declining. What about commodities? Look at that. Crude oil rebounding higher on Friday. Both the WTI and Brent gained about 2% apiece on Friday. On the other hand, the RBOB gasoline was modestly higher, gaining about half a percentage point on Friday, while heating oil moving higher and gaining about 1.5%. And the winner for the week remains natural gas, with a massive rebound, now trading above $7 per BTU and gaining about 8% on Friday alone. Let's talk about some energy news that we got on Friday. Most importantly, the much anticipated meeting between President Biden and MBS of Saudi Arabia. And here it is. We got it. The fist bump. How you doing, pal? Haven't seen you in a long time. Come on, man. And I don't know who's the genius who thought that a fist bump is better than a handshake. I mean, a fist bump, that goes between buddies. So that made it a lot worse. If you're calling MBS a bad guy, yet you're fist bumping him, this is a massive, massive embarrassment, and this is how you know that Joe Biden is toast. There's no 2024. He might not even be able to finish his first term. I can only imagine. I can already see the campaign ads. Oh, he called him a pariah, and here it is. Now he's fist-bumping the guy. Boom. Joe Biden's done. Now look at this. The beast is coming, parking. Joey B comes out. Look at this. I want you to pay attention to this. This photographer right here. Look at that. He's waiting and trained. This is not a coincidence, by the way. He's been waiting and trained to get the photo, because this is what the Saudis wanted to see. And after the photo is taken, boom. Got him. Let's publish the photo right away for the world to see. The embarrassment that we call Joe Biden. And of course, he got off with nothing. Total jerk off. He humiliated himself, and that's it. No deal. The Saudis say we're not going to do any deal regarding production of oil without OPEC plus. And the plus means Russia. In essence, the Saudis said to Biden, hey, we know that you want us to go against Russia, but we're not going to do that. We have a cooperation agreement called OPEC plus. We're going to abide with that. And that's that. So goodbye. Take a hike. And of course, oil prices shot up higher by 2.5% as no immediate Saudi output boost is expected. When we talk about Russia, how is sticking it to Putin going on? Sticking it to Putin, brah. Well, here it is. Saudi Arabia, the world's largest oil exporter, more than doubled the amount of Russian fuel oil it imported in the second quarter to feed power stations to meet summer cooling demand and free up the kingdom's own crude for exports. So the Saudis, whether Biden likes it or not, they're getting closer to Russia. And this meeting was absolutely nothing. Nothing came out of it, besides embarrassment for Joey B, of course. On top of that, last month, Russia's share of India's oil imports surged to a record high. Even the Indians are saying, Mr. Biden, go take a hike too. Goodbye. We're sticking with the Russians here. They're giving us cheap oil. We're taking the cheap oil. No problem. And of course, remember the price cap on Russian oil, courtesy of transitory Yellen, the genius that she is? Well, that's not going on as expected, of course. And now Yellen's deputy is rejecting secondary sanctions for Russia on the oil price cap deal. Meaning, let's say India doesn't abide by the agreement, or China, we're not going to do anything about it. We're not going to do any secondary sanctions about that. So again, what is the point of the price cap on Russian oil if Brazil, China, and India are not going to abide with it? If they're going to still buy Russian oil, ignoring the price cap? What is the point here? Because so far it has been absolute humiliation for the West, both in geopolitical terms and economic terms. On top of that, now even the European Union is caving to Russia's demands. Lithuania tried to play big by banning rail transport of goods between Russia and Kaliningrad. Well, the Europeans said, you know what, Lithuania, I think you're going to have a big problem here. The Russians might drop a nuke on you, and you'll be done in like 5 seconds, max. And we're not going to do anything about it, even if you're a member in NATO. So pretty please, just open the railways already. And Lithuania, of course, bowed down to the European Union, and there you go. Another win for Russia. How many more, folks? It's an absolute humiliation for the West. Unfortunately, of course. But back to the futures. What about softs? We're seeing a big rebound in cocoa and cotton futures. Cotton futures gained about 6% on Friday. Likewise, we have a rebound in coffee. Now, coffee futures are trading above 200 once again, gaining about 2.5% on Friday. Likewise, sugar futures closed the day with gains of about 1%. On the other hand, we have decliners, be it modest declines for both OJ and lumber futures. Metals, muted action for gold. Gold is waiting and waiting for more clarity on the dollar. But silver, platinum, and copper managed to rebound higher regardless of the muted action in the dollar. On the other hand, palladium futures continue to go down, losing about 4% on Friday. What about meats? Muted action across the board, but we have notable declines for feeder cattle futures on Friday. Now, mind you, meats futures have been performing a lot better than softs, metals, even energy futures, with exception of natural gas, in the last few weeks. What about grains? We got declines for soybean meal futures, wheat, and canola. On the other hand, we have muted activities for corn and soybeans, while we got sizable gains for soybean oil futures on Friday, gaining about 4%. Likewise, notable gains for both rough rice and oats futures, the rebounding higher from steep declines, at least talking about oats. Now, before we move on, listen to this headline. It reads, Wheat wipes out year's gain to help ease food inflation fears. So all of these gains, the massive pop in wheat futures, that's now gone. Poof. Why? Did all of a sudden the supply of wheat increase? Of course not. Did we print 3D wheat? Of course not. Did the Martians drop their supply of wheat to help us out? Of course not. Still, global crop trade remains heavily disrupted by the war, adding to worries about a worsening hunger crisis. Wheat futures had surged more than 70% through early March, just after Russia started its attack, and remain historically high. Negotiations this week over unblocking Ukraine's stalled grain exports through its Black Sea ports made initial progress, while a final deal has yet to be agreed. In other words, the supply is not here yet. We still have an imbalance between demand and supply. The point I'm trying to make here is what I've been teaching you all along. This inflation is not about supply and demand. It has never been this case. Inflation has always been a monetary phenomenon, and I made a video about it in details, teaching you that this is not a supply-demand problem. You'll watch, you'll see, inflation will go down when the Fed starts tightening the monetary policy. It's not about a supply-demand problem. You think oil went down in the recent few weeks because the supply all of a sudden came back to the market? Of course not. It's because the Fed is tightening. It's all about the Fed. This is what economists and the geniuses that teach you in college never really taught you. They teach you that inflation is an imbalance between supply and demand. It's all about the thing, disrupting factories and all of that bullshit. It's all about the monetary policy. If there is one thing you need to learn from all of these videos that I'm making, this is the one thing you need to learn. Moving on to the options market, the casino, big casino, what's going on here? The hottest table on Friday was Apple at around 1.6 million contracts traded for that name. About 62.5% of those were calls. And at number 2, Amazon at around 1.5 million contracts traded for the name. About 59% of those were calls. Number 3, Tesla at around 1.3 million contracts traded. About 57% of those were calls. We're seeing some improvement in the put-to-call ratios. Folks are buying more calls now. The volumes are improving, at least for the big three names. All of these are good signs that we could see a sustainability in the rebound in upcoming weeks, but that depends on more follow-up. We need to see more buying of call options. This is by itself is not enough. Now, let's move on to the unusual activities that took place in the options market on Friday. We start with the ticker BABA, Alibaba. The name rebounded significantly in the last few weeks, but somebody is saying, hey, maybe we should hit the brakes here. Maybe when American equities start to perform, we don't need to buy Chinese equities anymore, and therefore they bought some puts here, the 95 puts, with expiration date July 22nd, with expectations that Alibaba could go down by more than 7% by then. They paid around $1 a piece to enter this trade, all in all spending around $1.3 million. Next, what about the ticker KURA? This is for a company called Cura Oncology. Now, this is literally an unusual trade because you don't see this name often. What does that mean? The spread is going to be wide, but when it comes to these medical names, somebody knows something. An insider knows about an upcoming FDA approval, for example, and therefore they're buying calls. In this case, they bought the $20 calls for the expiration date, August 19th, with expectations that the name could move higher by more than 12% by then. They paid around $2 a piece to enter this trade, all in all spending around $2 million. What about the ticker LNG? This is for Cheniere. LNG gas, no surprise here. Somebody's betting for a rebound for this name. We're seeing natural gas futures rebounding. Perhaps stocks will follow up. In this case, the trader bought the 145 calls for the expiration date, August 19th, with expectations that LNG could rebound higher and gain more than 17% by then. They paid around 90 cents a piece to enter this trade, all in all spending around $700,000. What about the ticker COIN? This is for Coinbase. Somebody's betting for a rebound here. You're seeing the theme. The theme is risk on. Tech stocks going to rebound, Bitcoin will rebound, and therefore Coinbase could catch a rebound rally. And this somebody bought the $60 calls for the expiration date, July 22nd, with expectations that the name could move higher by more than 12% by then. They paid around $1 a piece to enter this trade, all in all spending around $700,000. Lastly, at the bottom of the table, what about the ticker TSLA, the souffle? Somebody's betting for a big rebound. Well, it is rebounding above 700 now, but more gains to come. They bought the 765 calls for the expiration date, July 29th, with expectations that TSLA could move higher and gain about 6% by then. They paid around $19 a piece to enter this trade, all in all spending around $9.5 million. Moving on to the heat map analysis, what's going on here? This is the heat map on Friday, the tide that lifted all boats, options expiration, retail sales data, the Empire State data, Biden's visit to Saudi Arabia, Manchin's comments about solar and energy. Doesn't matter what the reason is. The reason is we have an algorithmic rebound that lifted all boats, with very few exceptions. Nothing to see here. Let's contrast this with the weekly heat map, and now it looks kind of different, right? We have weakness in energy, in banks, in healthcare, and industrials. The recent winners, the defense contractors, were down big. Lockheed down over 5%. But we have good news for Lockheed. The United States finally successfully tested a hypersonic missile manufactured by Lockheed Martin. We have Lockheed's earnings coming up this week, so pay attention to that name. We'll talk about it in the conclusion of this video. But we also got weakness in healthcare, not a lot. The big pharma still holding. Weakness in the big cap technology names. Microsoft, Google, Meta, Tesla, Amazon, all down for the week. Likewise, software down big for the week, perhaps on the commentary from ServiceNow. Yet the mixed signals continue. We have Apple outperforming for the week, Microsoft down 4%, Google down over 6%, yet Apple gaining about 2% for the week. What's going on here? Likewise, chips moved higher while software went down. Right now, stocks are anticipating earnings, meaning every man, woman will stand on their own. If the company delivers an earnings, the stock will shoot up higher. If not, it will go down. So for now, there is no theme to bet on. The theme will be, what do we do with these earnings? The assumption is they're going to be bad, but is that priced in or is it worse than expectations? And if it is, then down we go across the board, even companies that are not reporting. So for example, if Netflix, for example, this week bombs again and it goes down big 10, 20%, you'll see other names going down too. But that presents us with the opportunity that some of these names that went down big in empathy of Netflix earnings, in this hypothetical example, they could deliver when their time comes. And that presents us with the opportunity of buying the dip in these names, at least via call options. We'll talk about that when we get there. But for now, there is no theme looking at this heat map. All what I see is opportunities for names that did not go down big and they should go down. Maybe this earnings season will present us with the reality for these companies. They go down big and hence the opportunity of buying put options. But in reality, the majority of the opportunity will be in buying call options for names that went down big, but perhaps the earnings will show that for now, these companies' earnings are holding better than expected and hence the rebound. Now, let's move on to the weekly heat map for the ETFs. Throughout the week, we've seen outperformance and a contrast between the XBI and growth. XBI was moving higher while the IWF, for example, VUG and growth were moving down. We said one of these two will be right by the end of the week. Is it the XBI biotech saying, hey, it's time for risk on, meaning growth should catch a bid? Or is it growth being right and the XBI went a little ahead of itself? Now we know the answer. The answer is the XBI went a little, maybe a lot, ahead of itself. And therefore both the XBI for biotech and growth were down for the week. Now, value ETFs were down, but they managed to outperform growth. Likewise, when we talk about internationals, they're all down for the week, but leading the declines, the EWZ for Brazil, the commodities giant. If we have a rebound in commodities, the EWZ will catch a bid. And then we have Chinese ETFs, the FXI, MCHI, which usually, not always, but usually track growth and risk on kind of moods. So when you have the Chinese ETFs and the EWZ down, what's going on here? One of these two will rebound higher next week. Is it going to be the EWZ? That depends on how commodities are going to perform. Is it going to be the FXI Chinese ETFs? That depends whether we have risk on or not. My bet is it's going to be the EWZ. We will look at commodities ETFs. They're all down for the week, including gold, silver, GDX down big, over 5% for the week. Yet natural gas ETFs, the ticker UNG and BOIL, gained big for the week. And that's because natural gas futures rebounded big. Now, the beauty of this heat map versus the stock equities heat map is you can see a general theme here, which is all ETFs were down, to muted at least, with exception of what? With exception of chips, the SMH, the SOXX. So for now, for this week, all in all, what was the theme? The theme is chips higher, the rest down. Why are chips higher? Number one, we got good results from Taiwan Semi, the ticker TSM. We also have the upcoming so-called CHIPS Act, which is a robbery, a theft of taxpayer money, worth over $50 billion. All of these companies, NVIDIA, AMD, Intel, they have record profits, billions of dollars. They can build their own factories. They don't need a multi-billion dollars handout from the taxpayer. But again, your beloved politicians are probably getting a kick out of this in their Cayman accounts. And therefore, unfortunately, the CHIP Act will pass. And you have Nancy Pelosi's husband already betting on it, buying call options on NVIDIA. And therefore, traders are also betting on it, and that was another reason, another tailwind for the outperformance behind chips. With that being said, let's move on to charts, and we start with SPY, the S&P 500 30 minutes chart. What's going on here? We got the gap higher on Friday, forming a bull flag pattern, which is already playing out, but it stopped at around the resistance of 385. Now, if this resistance produces a pullback, the question becomes, how fast will the dip be bought? If it's bought right away, so far so good. But if it goes down all the way to filling the gap at around 378.87, well, the entire rally is gone now. I don't believe that will happen. I believe we will get a build-up and a pop higher again. If that is the case, and 385 is beaten, what is the next resistance? The answer is, how about filling the gap above at around 388.71? Another point is the RSI and the MACD indicators. They're getting a little overextended here. They're not at overbought, quote-unquote, territory right now, but that merits a pullback. And if that happens, once again, the question becomes how fast will they buy the dip? Here's the daily chart for the continuous contract for the SPY, the S&P 500. Again, the chart is not maintaining the pattern of higher lows, but it is at least for now maintaining range. Matter of fact, it popped above the resistance of 3,855. If it maintains trading above that level, so far so good for the bulls. The ultimate win will be beating 3,960 as resistance for the week, turning that into support, of course. The volume went down on Friday, which is good news for the bulls. The momentum indicators maintain positive readings. That's also good for the bulls. Now, the bears are betting that this is a larger bear flag pattern. But even if they're right, it's going to take a while for it to play out. Unless, of course, we see big violation of support lines fast. And the support line I'm looking at is 3,720.5. Now, what about the weekly chart for the SPX, the cash index, the SPY, the S&P 500? So far, we had a downtrend, as you can see from the curve, which acted as resistance over and over and over and over again. Now the chart managed to break above that curve line, breaking the trend, the negative trend, at least for now. You look at the RSI, it appears at least, bottoming for now. You combine that by looking at the MACD indicator from a weekly chart perspective, it looks that it is bottoming too, and it's about to cross, producing green impressions in the histogram. What does that mean? It means the end of the bearish momentum and the start of a new bullish momentum. That doesn't mean that the chart is going to go all the way back to all-time highs, but it means that we could catch a relief rally. And if that happens, how far can we go? The answer is, how about to the top of the breakdown candle, which happens to be at around 4,134.72. That would be about a 7% rally from this point on. And if that happens, let's say it takes all the way till September, beginning of September. Then comes the reversal as we find out that inflation is sticky, keyword sticky, and the Fed has to do more. And perhaps at that time we find out more skeletons in the closet of this financial market, maybe in the crypto market, and we see the reversal and a move down again, making lower lows. This is at least my projection for now, because when you look at the monthly chart for the SPX, the cash index, the cycle topped already. Whether we get a relief rally, a rebound for the summer, that doesn't matter. The damage is already done, and the chart has to go down to the next supportive Fibonacci zone. What would that zone be? Here it is. I'm highlighting it in yellow. And in the worst case scenario for now, looking at the Fibonacci retracement, we could go down in the SPY, the S&P 500, by another 28% or so. And that would be the support zone. And then we depend on the facts and the fundamentals. If the fundamentals worsen, we go down more. If not, then around that range, we will find the bottom. What about the Qs? 30 minutes chart. What's going on here? We got the pop, the gap higher on Friday, forming a bull flag pattern that should play out all the way to closing the gap above, or if it has more energy, it could go all the way to 297.5. That would be a stiff resistance. For now, both the RSI and the MACD indicators are getting a little overextended, so wouldn't be surprised if we get a pullback, but the pullback should not erase a lot. If we go down to closing the gap, that would be bad, and if the chart doesn't rebound after closing the gap, then it's going to go back all the way to 285, and that would be bearish, not bullish. But for now, looking at the chart, it has what it needs to move higher, specifically if the dollar cools down. When we look at the daily chart for the continuous contract for the NASDAQ, this chart is still maintaining a pattern of higher lows. It is within a range, but it's about to crack the resistance at around 12,207. If it passes that test, it would be good for the NASDAQ, unleashing more energy to the next resistance. The volume moved down on Friday. That's a good sign. The momentum indicators are improving. Another good sign for the bulls. The bears, again, the argument goes, this is a bear flag pattern. This is a relief rally. We have a lot of weakness. The chart should go down, and they give you fundamental reasons. For now, that's all good, but until we get a technical reversal signal, the bears have the weaker argument, at least for now. We will look at the weekly chart for the NDX, the NASDAQ 100. What's going on here? We have a massive decline after breaking the trading channel, which was bullish, producing about a 30% plus drop from the top. But for now, looking at the chart, it appears that it is attempting to find a bottom, at least for now. You look at the MACD indicator, you look at the RSI, they're about to cross, they're about to move from negative to positive. If that is the case, how big will the rebound/summer rally be? The answer is, when we use the Fibonacci retracement, we could go back all the way to 13,000, which would be a gain from this point on of about 8%, and then we'll take it from there. The reality is that rebound will fade away, or we might go even further to the downside, but we'll take it one day at a time. What about the IWM, the Russell 2000? What's going on here from a 30-minute chart? We got the move higher. Now the IWM is trading above the stiff resistance. We thought it was soft, but turns out it is stiff, which is 172.25. But that's behind us now. The chart is consolidating in a bull flag pattern, and we're eyeing 174.22 as the next support. Now, here's the weekly chart for the IWM, and the most important number is 163.62. Why? That was the gap. And from that point on, the IWM, once it went back in retracement and closing that gap, it has been going back and forth, consolidating, asking for buyers. As if the IWM, the Russell 2000, said, I'm done with the downside, at least for now. I managed to close the gap. Any buyers want to show up here because I'm ready to go higher. If the IWM indeed catches a bid, and it goes higher, how high can it go? How about 187.92? That would be a stiff resistance, but that would be a gain from this point on of about 9%. But perhaps this is the most important chart you want to pay attention to, which is the dollar index, a daily chart for the Dixie. Is it topping? You see that little yellow trend line that the chart managed to bump against? Now that would be my resistance target, and if it indeed becomes the top for now, I'd be so proud of myself. But for now, do we have a confirmation that this is indeed the top? Not for now, but we have signs, we have signals that it could be the top. From the MACD indicator, from the hour side, they're all topping for now. They're all getting overextended, indicating that the ground is fertile for a pullback in the dollar. And here it is once again. If we zoom out to a monthly chart of the dollar, I'm leaving all of that mess just for you to see, because we talked about it before in a previous video. It is a channel, and the anticipation for now is the dollar already hit the top of that channel. It should pull back, at least in the short run. If that is the case, that would be good news for gold. Here's a daily chart for gold. My preference is it goes down to 1,685, catches that support, and then it rebound higher. But that might not happen. We might see a rebound in gold before that if the dollar already topped. But I guess the main question will be, do we have a confirmation that we have a top in the dollar? The answer is no, at least not yet. And until we get that, we're not going to know that we have a bottom in gold. Now, keep in mind that a drop in the dollar is a double-edged sword because, number one, it issues a relief rally in equities. A higher dollar is not good for multinationals, but a drop in the US dollar also increases inflation because you will see commodities rebounding higher. On top of that, import prices will move higher. So it is a double-edged sword for now. The equities market, though, will take any relief it can get for now to produce a summer rally. And if that means the dollar goes down, so be it. Here is UK oil, Brent oil, 4 hours chart. What's going on here? It is trading above 99. It is maintaining the double bottom for now, but it remains to be seen. After the digestion of the news that we got on Friday throughout the weekend, how will the market react on Monday and throughout the week? My hunch is the worst of the drop in oil is behind us now. That doesn't mean that oil should move higher all the way back to all-time highs. In my view, absent of any extraordinary event, such as an entire cutoff of Russian oil, we already have the top for this cycle for now, meaning oil should rebound if it does all the way to maintain above 100, maybe above 105, and that would support the sticky inflation theory. What about a daily chart for the 10-year yield? What's going on here? It appears that it's not going to make it above 3%. If anything, it appears that the 10-year yield wants to go down to 2.7 at least. Now, what would support that? The answer is the deal or no deal game that we played in the beginning of the video. If the Fed is not going to hike by more than 100 basis points this meeting, then the assumption is the 10-year yield should go down. If that is the case, here's a weekly chart for the TLT. The TLT should be moving higher. We got a confirmation now in the MACD indicator by the weekly closing that the bearish momentum in the TLT is over for now. It means that the bullish momentum is about to start. If the TLT goes higher, the 10-year will go down. But again, all of this depends on rate hike expectations. For now, the market appears to be cooling down on the 100 basis points hike. It appears that we're favoring the 75 basis point hikes and then lower than that in the September meeting. This will support a higher TLT. What about the VIX? What's going on here? We have the beginning of a negative momentum, at least from the 4 hours perspective. Will the VIX rebound from 24.29, which is the support for now? I doubt it. I believe the VIX will go down further all the way to 20. That will be the last support. That will support the summer rally theory. And if we get there fast, I will be buying puts once again. Because at that point, when the VIX goes down to 20, puts will be cheap. You can hedge your portfolio for cheap. And you can bet on a downside perhaps in the fourth quarter. What about the VXN, the VIX for the NASDAQ? 4 hours chart, once again, it lost the most important support of 32.72. The next support is 27.5. It appears that the chart, when we look at the MACD indicator, has been going back and forth between bullish and bearish momentum. Indecision. Now, could we see more clarity this week? Yes, we can. If the VXN goes down all the way to 27.5 and it breaches that support, then the last support would be 21, and that would support a relief summer rally in the Qs, the NASDAQ. But I doubt that the VXN will make it easy for us, meaning we will see lots of rebounds before it goes down to 21. What about Apple, the daily chart? What's going on here? It is now trading above the resistance of 150. So am I shorting, as I've said last week? The answer is not yet, because we got a slew of data that supports a summer rally theory. If that is the case, can we see a summer rally in the SPY and the Qs without a participation of Apple? That's doubtful, but we have the next resistance at around the trend line in yellow, which could coincide, depending on the time, with the next resistance at around 157. Now, just to illustrate for you, I'm zooming out, leaving all the markings in the chart. It's a mess, but you can see where that trend line is coming from. It is a channel that was broken. The assumption is once the chart retraces that broken trend line, it becomes resistance, a stiff one. And that could be the opportunity for a bet on a reversal in Apple. What about Tesla, the souffle, 30 minutes chart? What's going on here? Last time around, we talked about the reverse head and shoulder formation. We talked about the descending, sloping line of resistance. That was broken to the upside. So far, so good. The chart's now consolidating and asking for buyers. If the buyers show up, then we will see more gains to come, and the next resistance would be at around 766.5. The bears are not going to short unless we see another violation of 700 as support. But for now, each time Tesla dropped below 700, the rescue operation, the buyers immediately showed up, because they know 700 is a critical line in the sand in Tesla. You break below that, you close the week below 700, it's over. Moving on to tulips, BTC, what's going on here? This is an hourly chart. The bull flag played out. We're now above the support, used to be resistance at around 20,450. The chart is making a pattern of higher lows. So far, so good. But it needs to maintain 20,450 as support. If the chart breaks below that, then the risk-on mode goes out of the window. And here are some bonus charts for you. We start with the ticker ADBE. This is for Adobe, a weekly chart. What's going on here? It appears that the negative momentum is bottoming for now. The chart retraced from the Fibonacci support, and it is moving its way higher. We're seeing an improvement in the RSI indicator. It appears that it is bottoming, and it is reversing the negative divergence. On top of that, the MACD indicator is also moving higher, firming up and showing us green impressions on the histogram. They're still weak, but there's plenty of room for these indicators to become stronger. If they do, that means a bigger rebound for ADBE Adobe. If there is a summer rally, it will be led by names like Adobe. Oversold, very beaten and bruised, but it remains a high-quality company. If there's a summer rally, a rebound, this is a name I'm eyeing for now. Another one is the ticker AMZN for Amazon. I was already holding calls. I closed those on Friday on massive gains, but the chart suggests for now that we could see more gains to come. For now, it appears that the chart is finding a bottom. It is in a bottoming process, at least for now, at around 100, which happens to be a Fibonacci support. Went back and forth, retesting the same support over and over and over again. If the appetite for buying is here, if the earnings are not as bad as anticipated, we could see a rebound in Amazon, because when we look at the MACD indicator from a weekly perspective, it is supportive of an upcoming turnaround in this stock and a move higher. And if that happens, how high can the chart go? The answer is, how bad to the 130s? That would be my target for taking profits. Another one, what about the ticker HD for Home Depot, the weekly chart? Similar story here, beaten, bruised, but remains a high-quality name. It is catching support. When we look at the MACD indicator, it is crossing, producing a green impression in the histogram, indicating that the worst is behind us, at least for now, and the chart should be moving higher. In a summer rally, relief rally, doesn't matter what you call it, the bottom line is negative momentum behind the chart, positive momentum ahead of the chart. Now, what about the ticker OXY for Occidental Petroleum. This is a weekly chart. Buffett has been buying, supporting the name to move higher. But should you buy it at this stage right now? Technically speaking, no. You might catch a rebound here and there, but the weekly chart says it should go down because we're seeing a pattern of a head and shoulder formation. We're seeing a negative divergence on the RSI from a weekly chart perspective. We're seeing negative divergence and impressions on the MACD from a weekly chart perspective. I would rather be in the next chart, which is CTRA, Coterra, a natural gas play. Forget about oil for now. Chevron, Exxon, Occidental. If you want to play rebound in energy, stick with natural gas. You got Coterra, you got LNG, Cheniere, you got EOG, you got a lot of names that we talked about before in this program. But this is the weekly chart of CTRA Coterra, which I used to own, but it has now become overbeaten, oversold, a massive decline since the top at around 35, 36. It appears for now that the chart is making a reverse head and shoulder formation. It appears that we have positive momentum in the MACD indicator. Now, if natural gas futures continue to rebound higher, we will see names like CTRA also rebounding higher, and I'd rather play the dip in this chart than chasing Occidental. Another one, if natural gas prices continue to move higher again, another name that I used to own in my portfolio, one of my favorite names, MOS, Mosaic. This is a daily chart. When I sold the name, I pointed out the head and shoulder formation. I pointed out the last support of 59. Since then, the chart went down big, all the way down to the original trend line in yellow, which should serve as strong support and produce a rebound rally. So this is yet another chart that I'm eyeing if we have a summer rally, but I'm also watching natural gas futures before I make that decision. And lastly, let's move on to the conclusion of this video. What do we have on the economic calendar this week? On Monday, July 18th, we have the Home Builders Index. Tuesday, July 19th, we have building permits and housing starts. Wednesday, July 20th, we have existing home sales, important data for the housing market. And then we have Thursday, July 21st, we have, per usual, the initial jobless claims on top of the Philly Manufacturing Index. And lastly, on Friday, July 22nd, we have the Manufacturing and Services PMI. Now, what do we have on the earnings calendar? Monday, we have Bank of America, Goldman Sachs, and IBM. Tuesday, we have Johnson & Johnson, Lockheed Martin, and Netflix. Lots of options trades potentials here. Wednesday, we have United, CSX, and Tesla. Thursday, we have D.R. Horton, American Airlines, and Snapchat. And lastly, on Friday, we have American Express and Verizon. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow.
A work ethic. I love it. That is why this country is still number one. Well, behind Germany and France and Belgium and Japan and China, and thank God for Bangladesh.